Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 5th, 2016. In this video, I wanted to take a look at the focus back on the long term, the bigger picture, the long-term outlook for the markets. I've done, in the last few weeks, the vast majority of my analysis, if not all, has really been on the short-term outlook for the markets, individual stocks, certain things. For those of you that registered on the site and you're in the trading room, you'll notice you've probably seen more 1, 5, and 15-minute charts lately than you have daily and weekly charts. And that's reflective of really, like mentioned, being short down into the lows recently and then reversing, especially a couple weeks ago, and expecting maybe some, I had a slightly net bullish bias, or I should say cautiously bullish bias is the term I like to use. And when I say cautiously, meaning I'm not aggressively engaging the market, but nor am I that certain of how far that bounce was going to go. We've had a little bounce from a few weeks ago, a couple Wednesdays ago. And where we go from here, that's why we're going to look at the long-term picture right now. So anyways, the 1 and 5 minute charts, 15-minute charts, when you see analysis posted on those time frames, those are moves that I'm looking at only that may last a few days, no more than a couple weeks, especially when you're down to the 1 and 5 minute charts. Those can be day trades or just 1, 2, 3 day trades. So keep that in mind, and I usually try to comment on that when I post those shorter term charts. Most importantly, if you're a long-term investor or a less active trader, disregard that short-term analysis. I can't give investment advice. I'm not a registered investment advisor, but I would say that, to those that are new to trading, learn to tune out the noise, focus on what's important to you. If you're not an active trader and you don't have those skill sets or the inclination to trade actively, just disregard the short-term analysis and pay attention to the bigger picture. In other words, don't try to game all the little micro bounces and short-term things that some of the more active traders in the trading room do. So with that being said, this is we'll go over the trend indicators and really just look at where we are. I've been wanting to do this video now for a couple days. For those of you who follow the site for a while, every now and then I'll talk about my trend indicators. That's what we're looking at here. I have a split screen with 4 different time periods. Actually, I should say there are 2 daily charts, a weekly chart, and a monthly chart. And we're going to start out looking at the Wilshire 5000. I don't often talk about it because I don't trade the Wilshire. I prefer to trade the higher beta index. If I'm trading large caps, I'll typically trade the NASDAQ 100 because you have more volatility. Although the NASDAQ 100 is not a very diversified index. And number one, it only has 100 stocks. And given that's better than the 30 stocks in the Dow, however, the NASDAQ 100 is not very representative of the economy. It lacks any financial stocks. The bulk of the NASDAQ 100 is made up of tech stocks. You have some biotechs in there, but very few. It's like I think less than 2% industrial. So again, it's not a very diversified index, but it is a great index to trade. A lot of traders trade the Qs. So with that being said, if we want to know where the market's going and where this is more reflective of the global economy, or at least here in the U.S., let's look at the Wilshire 5000. That's made up of roughly 5,000 stocks. It includes small, mid, and large caps. So you really have the whole spectrum of the stock market here. And the trend indicators, real quick, the short-term trend indicators, I have a few different levels I watch. One line here, the blue line, you can see. Let's go ahead and zoom this in. That'll make it a little easier to see, and then I'll hit on each one real quick. All right, this is a daily chart, 2-year daily chart. The black line shows the Wilshire 5000. The blue line here is the 20-day exponential moving average. And typically, when prices are below that, the trend is down. The trend is bearish, and when prices are above, the trend is bullish. So that is about as simple as you can get as far as using an MA for a trend indicator. Works fairly well for the S&P 500 as well, and most broad indices. Now down below, I also have on here, now you can't make it out on the chart. I have them really tuned down. I use a 13 and a 26 period exponential moving average, and those are represented down here in this custom histogram that I made. So when the 13 period EMA is above the 26, the histogram turns green. And when they cross over, in other words, a bearish cross, 13 down below the 26, this goes red. So that also helps to find trends. You can see here, and it does a pretty good job, as good as any out there. Nothing's perfect, nothing's 100%, but you get a little bit more complex because you're using a pair of moving averages. And as you can see, the trend is and has been the short-term trend bearish now for some time. So all the way back to this point here, which was early December, the short-term trend. All right, let's go ahead and move on. Now we go to the intermediate term trend. This is also a daily chart, except I'll use a different pair, a slower pair of EMAs. By slower, when we increase the period on the moving averages, you'll have fewer crossovers because they don't respond as quickly to prices. But those signals tend to capture larger trends. So this is my intermediate term trend, and it uses the 50 and the 20-day period EMAs. And again, same story. I've replicated it down here on the histogram just for a quick visual reference. So when I look at these trend indicators, at a quick glance, I can tell, okay, is a trend bullish or bearish? And as you can see, again, it's going to get you in a little later than the faster pair, and it'll get you out a little bit later, as you can see here. However, you have fewer whipsaw signals. So that's the trade-off with any moving average pair, using those for trend indicators, that the slower the pairs, the more accurate the signals are, especially for longer term traders. And again, it depends on your time period. Short-term traders, long-term investors shouldn't really care about that short-term trend indicator I just covered on the last page. However, when we get to these longer-term trend indicators, now let's move on to my weekly. This is the Wilshire 5000 on a weekly chart. And I don't have a lot of trading history on TC2000 for some reason. We'll only go back to a couple years on the Wilshire, but either way, you can see we're solidly in the sell signal, and this indicator has done a pretty darn good job capturing the major moves, even the cyclical, the bulk of the cyclical and bear and bull markets in going back for many years. We'll look at it in just a minute here on the S&P 500. I just want to mention that is solidly still in sell territory, i.e. bear market territory. When we get up to these longer term trend indicators like the weekly and the monthly, and here's our monthly. Monthly, I use a 10-6 EMA pair, and when I say a 10-6, that would be a 6-period exponential moving average on the monthly time frame, and a 10-period moving average on the monthly time frame as well. And those crossed back in January. So I was waiting to see a January close, and that's what we had. We had solid red closes. Sometimes I'll alternate between the ROC 13 and the ROC 12. That's just an additional trend indicator that I have. It doesn't have anything to do with moving average pairs. That's a rate of change. And both on the ROC, I can tell you the 12, I won't bother putting it up now, but that has been those have been on sell signals actually, as has the I'm sorry, I should even clarify. Back in December, we got a sell signal at the end of the month. Now, why the end of the month? Because this is a monthly time frame. What happens intra-month means little to nothing, in fact, less than nothing, because you tend to get whipsaws. There's quite a few times where intra-month you have a breakdown, and if you're going to go by a monthly chart using these monthly signals, you really should wait for a month-end close. Otherwise, it's possible to see the market dip intra-month and then come back up, and you would have seen some whipsaws along the way. Let's just take this backwards now and go from the long-term trend. S&P, we have a lot longer trading history, so you can just see how well. This is the S&P 500 now on all the screens, and you can see how well. Let's just go in recent years. This goes back to all the way to 1989. We did have a bear market. I don't know if you recall a sharp drop back here in the early 90s, and that was close. I'm using the measuring tool. I'm coming up. Maybe the S&P didn't drop that much. I believe the NASDAQ did correct over 20%, and so it caught that most of that. And this was the big bear market back in 2000 to 2002. So you see it got you in early. Again, we're using a month. This is the slowest trend indicator pair that I have, a monthly time frame. So you don't expect it to catch the very top. But you can see from the crosshairs, from there to there, it caught the bulk of that bear market. Put you in here long, kept you in the entire bull market. I should say the bulk of it, a couple months after the top. And that's where it told you, again, that we were in a new bear market, and that was the 2007 to 2009 bear market. So it looks like it got you in right around, well, that was right around the end of January there, and kept you short most of it. So this, for a 401k or armchair investor that's just trying to, maybe you don't even want to short the market, you just want to know when to get out. Well, this is telling you, and again, we have a couple whipsaws. Here's a whipsaw signal. We had a big correction, if you recall, back in 2011. In fact, I mentioned before on the site that was a bear market, or at least by definition, on some of the more volatile indices like the small caps, and I think the NASDAQ. A couple of them dropped over 20%. S&P fell a little shy of the bear market mark. However, like I said, I scrubbed the 10-6 EMA pair with a 13 or 12 ROC. And as you can see here, see the ROC 12, you have a couple whipsaw signals there, and that would have put you in there. And that's why, on this one, I've been using the 13 lately. And 13 is a little slower, so it will help avoid these whipsaw signals. So had you ignored the 10-6 EMA cross because you didn't have the ROC 13 going red, that would have kept you long throughout this entire bull market. Now, most importantly, we had, let's see, one trigger back here. We had a little whipsaw back in September, end of September. Keep in mind, I pointed out, we've been in a bear market. The S&P's topped in the middle of last year, so the S&P is well off its highs. And had you even taken that signal, it would have been tough because it would have appeared as a whipsaw because we had a few during the rally to failed highs, that failed attempt at new highs. We did go green. However, now we've had both in December as well as, January. We're in February now, and we have to wait for the February close. But we did have solid, let's just go over here. This is what I should be doing. Solid confirmed sell signals on both the 10-6 EMA and the ROC 13. And that's the monthly time frame. Now, if the monthly is telling us we're on a bear market, then of course the shorter term ones will as well. So I don't want to spend too much time. There's the weekly time frame you can see, and that's had us on a sell signal all the way back from early January. Given, had sell signals back here. So really the whipsaw, if you will, was this weekly trend indicator going back to buy signals. But again, you get a visual, and this is how I look at it. Long-term sell, bearish. Long-term weekly bearish. The daily trend indicator, the daily 2050 pair is still clearly bearish. Short-term bearish. So by all accounts, the trends are bearish right now. The only thing that's not, a little bugger that's held up, the one that has taken this market really to new highs, led the market, is the tech-heavy NASDAQ. And again, the NASDAQ, as I mentioned, is not, especially the NDX, the NASDAQ 100. This is not the NASDAQ composite. That one could trigger a sell signal this month if we close lower, but we'll just have to wait. We didn't get that in February, and that's what I wanted to point out. That's the one holdout, if you will. And again, not a very diversified index, so I'm not putting too much stock or weighting into that. And it probably has the most downside. Those big mega caps like the Apples and Googles of the world. If and when this bear market really starts getting underway, those things there's a lot of air to come out of those guys. So we'll probably see the NASDAQ play catch up on the downside. That's usually the case during a bull market tends to lead, and a bear market tends to lead on the way down. But again, you can glance and you see all these trend indicators on bearish, except you see the NASDAQ still holding up. Here's my weekly trend indicator, and that one has yet to even trigger. It hasn't even triggered a false signal, any type of red signals yet. So I'm a little cautious. This is what's giving me pause. Again, not super diversified, but it is and it is the leading index. So I'd like to see the NASDAQ join everything. And that's the reason why we're at this key support. I'm not pressing the shorts right now, nor do I have any long term. I have individual short trades on the site, but I'm not shorting the indexes right now. In fact, I just yesterday or recently covered the biotech short, thinking that we may look at a bounce that could last for a few weeks here. So either way, we're sitting close. We're very close, and at the end of this month, we could see the Nasdaq go and sell signals. All right, let's not do too much more. IWM, small caps. We can look at it either way. You can look at the index, the Russell 2000. You can see for months now, for many months, we've had even the monthly indicators on sell signals. The weekly long-term trend indicator went way back in September, and the Russell is very, very well entrenched in a bear market, and as by these metrics, by these trend indicators. Mid caps are an important index. I don't talk about them often, trade a lot. I know a couple of you do trade the MDY, which is the mid cap tracking ETF, and I'll try to incorporate that a little bit more into my analysis. And as always, if there's an index or security you trade, let me know. If I get enough requests, whether it's U.S. markets, a certain sector, futures, or international indices. I have quite a few of you that I talk to are all over the world. So if there's a lot of interest in a certain non-U.S. market or a security, just let me know. And if I have enough interest and it's I can incorporate that into my schedule, I'll make a point to follow that. So there's a trend indicators, folks. That's really the big picture, and I'll just wrap this up with looking at the other component besides trend indicators, which indicate that we're most likely in a bear market. Okay, so we just looked at, spent quite a bit of time on using moving average pairs to define trends. Again, and these are all things covered, over the years. I've always touched on these in the market updates, but it's been a while, really. And this is a chart. Again, I believe it's on the live chart page, and I've talked on for quite a while. Way back here, saying once this would be our once this rising wedge broke, it would be the beginning of the next bear market, and that's. And I pointed that's what happened a while back. I haven't had any reason to update this chart. Last time I updated it, we had the primary uptrend line break followed by question mark, meaning there's no reason to. You look at this chart, it just speaks volumes. And I've also in the past put up the time symmetry, the distance of these bear markets. The distance of these bear markets, the scope, duration, the bear markets. It's just, super symmetrical, very symmetrical, I should say, and that's the business cycle. Everybody attributes this bull market to the Fed, and obviously they juiced this bull market, and that's why we had such a tremendous run with the free money and the quantitative easing. But this, folks, is simply the business cycle. The economy works in these fairly, I don't want to call them predictable, because some bear markets and some expansions are longer than others, but we have bull markets, economic expansions, and then we have bear markets, economic contractions, in recessions and or recessions, and that's what we've had over. This is a 21-year chart, so we're looking at the business cycles and the stock market cycles over the last 21 years, and some people are in denial about bear markets. They think bull markets will go on forever. It's just a natural process of the economy. You have to have that washing out, the flushing out of, the weaker companies and excesses that are created during economic expansions and stock market bubbles. And so again, I don't know. I love bull markets. I love bear markets. It's simply just recognizing what cycle you're in and then trade a position accordingly. So everything's here. This has been covered. We had these patterns were all marked by these divergent highs confirmed in the RSI. Again, this is a weekly chart. Divergent tops on the MACD, I use a PPO on a long-term time frame. We had well-defined uptrend lines that define those bull markets, followed by uptrend line breaks. Such as we've had here. So now we're clearly, months into a bear market. You know, that bear market started well back in 2015. And again, we're looking at the Wilshire 5000, the single most representative index of the stock market. So, you know, don't be fooled by the fact, oh, well, the Qs just made new highs in late 2015. The Qs, that was a standalone thing. The small caps, the mid caps, the S&P 500, the Dow, they've all been in bear markets, you know, well off their highs for you know, not a year yet, but well over, you know, going on, I don't know, 8, 9 months, 7, 8, 9 months, depending on which index you're looking at. And so there's the big picture from, you know, using trend lines and support and resistance and that type of stuff. This is the OEX. You don't talk about it much. You know, OEX traditionally was just traded by, you know, institutions. It's the S&P 100 index, 100 largest companies. So some very similar to the S&P 500. This is one that I put up. These you can't make that out here probably on the video. I think it said just under 6 years duration. What I did is I measured the bull markets, and this one went under just under 6 years. This bull market here from 2002 up to 2007 highs was 5 years, 2 months, and 18 days. And then this one was just under 6.5 years. So you can see the symmetry. You can see the divergent tops, well-defined uptrend lines and breakdowns. Usually after a breakdown, you get that initial thrust and then either a backtest or a near backtest normally. That's what we had here, a breakdown, an attempt to gain, you know, get back and take out the highs, and then so far turning down. However, as I pointed out, you see this reaction low. Let's draw it out here. Screen draw. I think I only have white lines up right now, but we can put it there and just forget about the arrow. See, we're at support. I might not have hit that perfectly, but you see these reaction lows, and that's why I'm holding off. You know, I think once this level solidly goes, when I say solidly, you get these intra-week breakdowns, little candlesticks that pierce through and then shoot back up. But you know, shorting here now, we're at resistance. So shorting at resistance is contrary to trading. You want to cover, be long at resistance, and wait for a break of, I'm sorry, I'm using the wrong word, support. We're at support. So you want to wait for a solid break of that support. And I'd rather not jump the gun. The other thing giving me pause is, this may sound a little odd, it's almost too easy. You know, to me, it looks too easy. I don't expect this bear market to look identical to these last two. These last two were just so easy from a technical point of view. You know, short the trend line breaks, get short, stay short if you wanted. They were very powerful, you know, bear markets, very strong drops. And, you know, 2008, I was trading the rips and the dips, did good on both the long and short side. Those counter trend rips are very powerful if you can time them right. However, a longer term investor, or even a longer-term, less active trader. A longer-term investor just wants to be out of a bear market. You don't want your 401k in an S&P. You don't want to keep averaging down, throwing good money at bad. You just go to cash. That's my opinion. Now a more active trader can game all the rips and dips, and someone who's comfortable on the short side, excuse me, but not very active, just wants to get short and stay short until those trend indicators flip. Until, let's say, something's taken out here. We have no point right now. If this is a new bear market, there is no reason we should make a new high. We shouldn't even get close. We've already retested the highs at this point. So if we get too close to this level up here, that's going to call into question what's going on here. So as of now, the charts indicate more downside over time, but we just don't have that sell signal yet. And I also don't know. Part of me is thinking that we might not have this waterfall type sell-off. It might not be as easy as it was last time around. We may, in other words, consolidate here for a while, have more. I think it'll be a prolonged bear market. I think this bear market, instead of being over, you know, within a year, a little over a year or so, I think this one could go on for several years and be categorized by a lot of sideways trading action, some pretty nice rallies along the way as the Fed does everything in their power, the central banks, whatever power they have left. I think they're pretty much out of bullets. I think most would agree there. But, you know, maybe the government will kick in, start some fiscal policies that do things. And again, they're not going to let it go easy. And that's where I think a trader will earn their salt over the next couple of years, where this was a buy and hold market. You want to get long, stay long, you did well. these were all buy and hold markets or sell and hold. Buy and hold, that was the leading up to 2000 highs, straight up, straight down. Let's just do one thing here, color this arrow a little bit different. I'll go blue arrow. So you can see, in 2000, from mid 90s to 2000, it was straight up. Then we had a very powerful correction straight down. Those were very easy trending markets if you got on the right side of the trade, long or short, and just sat back. Will it be that easy again? I just don't think so, and that's what I'm looking at. I think this going forward, we'll see a market that's much more difficult to just position and sit back. I think it'll be a trader's market, as I said, or a market timer's market. You don't have to be an active trader, but I think there'll be periods of maybe several weeks to several months where we might make money on the long side, same on the short side as we just did, and there might be several months of sideways trading action, in which case less active traders just want to step aside, and that's what I'm going to work hard to do this year, is really try to identify those opportunities. As I've said recently, I expected sideways trading action. That's exactly what we've done. But again, right now I'm on the lookout because we are right here at that, on the cusp. We're sitting at the key support level right now, so we may be ready for that next thrust down at any moment, and I'll try to keep you posted on that. Okay, let's end it there. I can sit here and go over the small caps and the mid caps. It'll be the same story but uglier. The small caps buckled long before the large caps. So we're looking at the OEX here, which is, this chart would look very similar to the SPX. We looked at the Wilshire, and the small and mid caps, it only looks more bearish. So they broke down earlier, they've gone down more, and they are, for lack of a better word, much more solidly entrenched in their bear markets than are the large caps. And like I said, there's a little work to be done on the NASDAQ at this point, but that's the long-term outlook right now. So as such, I mean, the takeaway from this, if the primary trend is down, which I've made the case, then you want to sell the rips and buy the dips. It's the opposite of in a bull market, buy the dips and sell the rips. In other words, dip buyers from this point on, if we're in a new bear market, will eventually get burned buying the dips. I've been quick, covered on some of these, but when I'm talking buying to add to your positions. So if you have a 401k, you're a long-term investor, and you keep buying Apple, you're going to be buying it. You're going to be buying it all the way down at cheaper and cheaper prices until you reach that point where you probably throw in the towel. That's the point of capitulation. That's in every bear market. That's way down here usually. That's why you see that sharp leg down. So we haven't even, if this is a new bear market, I mean, there's a lot to go. So anyways, I'll keep you posted, and if anything changes here, I'm open to changes. If the trend indicators tell me otherwise, if price action tells me otherwise, then I'll adjust my bias. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.